Howdy there, folks. Welcome into today's video. 3 different things for me to react to in this video here today, okay? First one up here is this gentleman just sold Google stock. We're going to hear what his opinion is on Google here and why he sold the stock. And they talk a little bit here about selling stocks in general, their perspectives and whatnot. And I thought that was an interesting subject I could touch on in this video because I don't think I talk about that enough in terms of selling a stock and those sorts of things. So we'll dive into that one. I'll react to that one, okay? Second thing we're going to talk about is a stock I personally own. Shopify is up massively here today. This one's up about 25%. I own this stock in my Patreon portfolio, which, by the way, if you're looking to get access to my Patreon portfolio and all the moves I make in there, which, by the way, I'm making moves in there tomorrow, then check out the pinned comment down there. That'll be to join us in there and get access to the Discord chat and everything like that. But Shopify made a massive move here today. I want to talk about what happened there and share my perspective on, basically the huge news, okay? And then last video I want to react to is we're going to have a moderate recession in the second half of the year. It says Evercore's Altman. I want to hear what he has to say, why he believes that, and then we'll go from there. So appreciate everybody joining me as always. Let's just get straight into this, folks. 26,000, I think 400 plus subscribers now on the channel.
So you were more bearish,
right? It's tough to be more negative, but yes.
So you sold Google, you sold Alphabet. Is that reflective of that?
No, that's
that's
I spent some time with Brad Gerstner after it, and I've been thinking about it. That you have a monopoly in Google, right? 90% share. So Microsoft, brilliant coming out. It's not prime time ready. I listened to one of the founders of ChatGPT. They're rolling out more and more products.
Chat what, sir? Chat, what do we call that?
So that's enough for advertisers in an already weak advertising market to say, you know what, we're not paying monopoly prices anymore because now we've got a legitimate contender, which is Bing. So I believe that is going to pressure Google already, and Google has not launched products. So there aren't many monopolies in tech that survive the test of time. Google's, I think, on borrowed time in that regard.
Interesting.
Well, I think if you have a portfolio of stocks and it's working for you, I think you continue to hold that. But
how many people have? What does that mean?
Okay,
it means you own Apple, Microsoft,
okay, before we go further there, because we're going to talk more about just selling in general, selling portfolios, those sorts of things. Okay, before we go further, let me just touch on Google real quick here. Okay, so Google. First thing is attractive valuation on the stock. That's one thing Google has going for it. One of the best balance sheets in the world. Another thing Google has going for it. Still a very profitable company. That's another thing the company has going for it. Okay, what does the company have going against it? It has several things going against it. One is the potential threat of large language models for something like Google. What that does for, one, potentially stealing market share from people that might have used Google search, but rather than use this. Also, if Google's going to focus more on this, it's going to add costs to their business model. It's much more expensive to do some of these, I guess you can say, searches or basically what ChatGPT does versus like a Google search. Like it's a huge amount of money difference. Okay, I mean, you could be talking about a penny or two difference is like a game changer in terms of like how much more costly it is for this new service. So I'm telling you, like, that's going to be a potential big problem. You can dive down that rabbit hole if you want to. The government's on Google as well, which is also a problem. And then obviously on the YouTube side, they're facing a lot of competition, more serious competition than they've ever had, obviously from TikTok and from Instagram Reels. Those ones don't really compete too much in long form video content like this, right? But they're still competitive threats because they take time and attention away, especially from younger generations that might have previously used YouTube and now would rather just watch 15, 30-second clips of whatever they want to watch. And so so Google has some good things, but it definitely has some bad things, and that's why this stock's kind of in no man's land right now. And you're seeing a stock like Meta roar because Meta's got a lot of its problems in the past. It's dealt with so many other problems, and now it doesn't really have any problems. It's just kind of clear sailing. Google has a lot of major issues facing that company, and so I think it's just important to understand kind of the risk reward in regards to Google.
And NVIDIA.
If you're sitting on no, that's silly. But I think let's think about
what's silly?
What does that mean?
Okay,
it means you own Apple, Microsoft,
I think it means
and NVIDIA.
If you're sitting on no, that's silly. But I think let's think about my clients. Most of my clients are fully invested. And what are their portfolios doing for them? First of all, they have long-term capital gains, right? Why pay the tax bill? We all know that over the long run, the market's going up. If you're a trader and you're being cute, right, or if you're a trader, I shouldn't say if you're a trader, like maybe you don't buy stocks now. But what am I doing? I'm sitting on some cash but I'm mostly invested. And why am I sitting on some cash? Because I think this market is going to reward patience and give me better entry points on the stocks that I want to buy. But would I cut off my nose to spite my face and sell the whole portfolio? Absolutely not. And by the way, we cannot forget that this market is still at 5%.
And I agree with that, by the way.
Yeah, that's perfectly practical and perfectly fair. And if you know my stance on cash, we were actually having a discussion in the private stock group's Discord chat today about different folks' kind of cash levels and whatnot. Everybody was kind of sharing their perspectives on what they have for cash. As far as myself right now, so if you know me, I always believe in having like 10 to 30% cash. Okay. And so basically meaning, if you got, let's say $100,000 in your portfolio, do you have another $10,000 to $30,000 kind of laying around that you can invest? Okay, so that's kind of my perspective on that. So as far as me personally, where's my cash level right now? As far as me personally, right now, I'm probably at about 10% cash, and I've kind of been in that range for quite some time now. And the reason being is I've been a very aggressive buyer, especially in the back half of 2022. And so, I definitely depleted cash in a major way. The highest I've been in terms of cash in my life, actually, probably was at the very end of 2020 going into 2021. That was the highest level of cash. I was extraordinarily heavy cash. I think I was 30%, if not pushing above 30% cash. But at that time, there just weren't that many good opportunities in the market. So, if there's a lot of good opportunities in the market, I'm going to deploy money. I'm not scared like that. I'm going to deploy money, regardless of what's going on in the short term. And but if there's not any real good opportunities like there was at the end of 2020 going into 2021, then that's a moment I step back and I just kind of pile up cash there and I just kind of let things kind of play out. So that's kind of my perspective on that. Okay, if you aren't enough to invest it, then the market starts to go up. It's not a good feeling.
Agreed. Don't sell what you have. Don't.
On the other side, if you got no cash ever, like that's also a bad feeling.
Paying taxes, betting market's going down another 30.
I know, but are you supposed to be more negative today because you're worried about the regional banks and they should you don't think they should have hiked? Or are you supposed to be more positive? Hang on. Are you supposed to be more positive because you think the Fed's at the end of its hiking cycle?
I think you are doing your homework right now. Right, and getting ready. And I think you're getting more positive. So I'll give you a perfect example. You may recall that last November, we were having a bank discussion, and I said, I'm looking at Truist and I'm looking at PNC, but I'm not buying them now because we all know that interest rates are going up, and those share prices haven't accounted for the change in net interest margin that's coming when they need to pay more for deposits. So where am I today? I'm still looking at them. I haven't bought them yet. I don't know when the time is, but I know that massive opportunity is being created both in the banking sector and in other segments of the market. We're seeing huge bifurcations. So now what you're doing is you're getting excited and you're doing your homework and you're putting yourself in a position to buy stocks when they hit the right prices.
Yeah, so first off, I have no interest in playing regional banks, okay? But I can tell you if I was actually interested in buying regional banks, okay, and buying something like the KRE, I would do it likely within the next, I would say 2 to 4 weeks. If I was even going to do a play like that, in which I'm not interested in that. But if I was, at the end of the day, when you look at this sort of level of fear in regional banks, it doesn't get much worse than that. And that's the biggest factor in terms of if the KRE is going to go up more or up and start bouncing back, or if it's going to go down more. You're going to need a whole new level of fear on regional banks. And it's not going to get much worse, and it's going to be right around this time. So if I was actually interested in that, I would play it in like the next 2 to 4 weeks. But yeah, it's not even worth my time and attention, to be honest.
The Fed pausing, if they came out and said they'd pause, I said yes, the market would rally, but I would be selling into
Well, he sort of implied that they're at the end of the road.
Right, but what's not paused is the impact on the economy, as Josh mentioned. I've mentioned repeatedly, lagging effect. Here's what I do. You have your shopping list, but as I've said many, many times, I'd rather miss the first 10% rally instead of losing money and taking the next 20% down. So you have tremendous alternatives you haven't had in 15 years. And that's 4 to 5% in fixed income and credit. You're going to get monstrous conditions and you're seeing them already.
Well, no, and that's what Gunlock was talking about yesterday too, right? You can get higher interest rates by a lot. Yep. Thanks to the 500 basis point increases that you've got. You can get bills at 5.2% for a couple months.
Yep.
The 2-year Treasury's fallen 100 basis points in terms of...
I bought a Wells Fargo CD 2 months ago at a 5.3%. I bought 6 and 2 month paper near 5%.
But see, that's why, Josh, the 25 on its face doesn't mean anything. 25 in total to get you to 500 basis points in a little more than a year, especially when you have... banking issues that feel unsettling, that's everything, because it just underscores the alternative that exists today to equities if you don't want to have the risk.
Yeah, so that gentleman has flawed logic, in my opinion, in regards to his whole fear. And he's not the only one. I hear a lot of people, on Wall Street talk about this. Oh, I'd rather, miss out on gains, because I'm afraid it might go down another 10% or whatever. And it's just like, it's such flawed logic, okay? You just look at year to date. This is not even these stocks from the lows or anywhere close to lows, okay? And you look at a stock like Shopify, it's up 63%, right? Shopify has been a steal deal. At the lows, I think Shopify was down to $25 or so, right? And extraordinary opportunity there. And you could say, well, it might go down another 10%, so I'm not going to buy it. And so you missed out on 63%. AMD's up 36% year to date. Snowflake, 14% year to date, right? Mr. Softy, 28% year to date. I say, well, maybe Microsoft's going to go down another 10%, right? Good old Tesla, Tesla. I mean, even after its massive drop here, it's still up almost 50% year to date. Well, I was afraid it might go down to $90 or $80 or whatever, right? So it's a huge flawed logic. And obviously the most extreme example would be something like NVIDIA, right? Up 92% year to date and up 100-something% from its lows that it reached back in the fall time of 2022. So at the end of the day, when you see extraordinary opportunities out there in the market, you got to take advantage of those opportunities, especially in those sorts of incredible companies, right? Next up here, Shopify. So Shopify's up huge here today. Reason being is they're selling off. Well, one, there's some excitement around the numbers and the earnings, okay? But two, the main reason is they look like they're going back to more of an asset-light business model. They're doing a big layoff here, and they sold out of one of their businesses that was kind of making them into an asset-heavy business model, basically meaning, CapEx and what it just costs to run the business is going to be exponentially more, kind of like Amazon has gone much more asset heavy over time. Because you think about Amazon, like they're not an asset light business model. And I own Amazon. I'm planning on buying it this whole year, and I love Amazon, right? And they built an incredible monopoly, but they're very asset heavy. Think about Amazon. It's not just this website that you order stuff from. Now Amazon buys their own products, right? And now they even make a ton of their own products that compete with other people's products. Now they have all these massive amount of warehouses everywhere, right? They have this insanely huge employee force. They have, the trucking fleet, the planes. I mean, it's incredible now. So Amazon's built a very asset-heavy business model. Shopify's always been somebody that succeeded with an asset-light business model and kind of just been the one that we're going to make your software work, and we're going to focus on profitability. We're going to focus on building a great cash flow business. And it looks like Shopify is going back that way. And so I wouldn't be surprised if Shopify continues to perform very well over the next several years. And so as a shareholder of this company, I'm more certain about the stock now than I was 24 hours ago. Because now I'm even more certain that their margins are going to be in a very good place. And their revenue growth, I've never really doubted that. We're in a slower time period, and that's fine. But my only worries with Shopify is kind of margins, profitability. And they just cleared that out, man. With this layoff, the 20% layoff, and then selling out that business, yeah, that's huge, man. So I'm actually much more excited about my investment in Shopify than I was previously. Let's put it that way, okay? Alrighty, next up here, we're going to have a moderate recession in the second half of the year, says Evercore. Let's hear what they have to say, and I'll react to that and give my perspective.
Main stories today, the impact of the Fed's 10th rate hike in a little over a year. The central bank dropped hints the current tightening cycle is at an end. Joining us now on that and the debt ceiling drama, Roger Altman, founder and senior chairman of Evercore. Roger, great to have you here. You think the Fed did the right thing? Has your opinion changed at all, seeing the continued turmoil that we're seing in regional banks?
I don't know what I do in my life, man. Like, I should have worked for CNBC. Like, these people always getting days off. I always notice, like, all these people getting vacation time all the time, all these days off, man. I'm lucky if I take one vacation a year. I took a vacation in January. I'll probably not take another real vacation until next January. I'm like, man, these people at CNBC got it good, man. They probably get 3-4 weeks of vacation. They probably get sick days. It's like I wasn't even feeling good the last few days. I'm feeling about 80-90% good today, man. Don't get no days off when you own your own business. It's just not the way it works.
Make the right decision, Melissa, for two reasons. First, everybody knows inflation is still running too high. It's running about 4.5% using the PCE deflator. It's just too high. So for the Fed to have stopped relative to that, I think would have been a mistake and would have undermined confidence and actually would have been a very negative result. Secondly, if the Fed had paused, I think the implication would have been the banking turmoil is much worse than all you guys think. And I think that would have been destabilizing from a market point of view, and the Fed knew that. So for those two.
Alrighty, folks, it's the time. The time has come. We're looking up true-flation numbers. Has anybody seen the new true-flation numbers here today? Can anybody guess it? Let's see what it is. And, oh, man, you serious? Are you serious? Come on, man. Still 3.84. That's what it was yesterday. So no change in true-flation numbers here on this one here, folks. Oh, man, that's just disappointing.
Reasons I think it made the right decision. We'll see based on the data, as they said in their statement, whether this is the end of the hiking cycle or it isn't. But I think as far as yesterday is concerned, right move.
It's weird that you think two psychological effects would be more destabilizing than the actual move itself. In other words, the 25 basis points, all these marks on the duration mismatches, you got another, and T-bill yields, and anything that is causing deposits to flow out of regional banks is going to be exacerbated by another hike of 25 basis points. But you're saying that just because the Fed would look like they knew something psychologically, or just because it would look like their resolve for inflation is being, both of those things are psychological reasons.
Well, I'm not sure the first one is psychological because, look.
Well, how do we even know about the lag effect, Roger? How do we know inflation's not, given what we've already got, especially with the credit contraction, how do we know inflation's not already headed at 2?
We don't. And in fact, our view on the research side of Evercore is that we are going to have a moderate recession in the second half of the year. Then inflation by the end of the year will be around 3. And that by the middle of 2024, and perhaps a little earlier, it'll probably hit the Fed's 2% target. But I think for the Fed to have stopped and said, we've done it in terms of inflation, I don't think that would have been the right decision.
Because they were so bad.
I don't know if that was really, if they paused yesterday, I don't think that's necessarily saying we've defeated inflation. That's just saying we think we're at a policy stance that's restrictive enough now at this point in time, in my personal opinion. If they had accepted, a win, that would be them cutting rates. Let's cut rates down 4% from 5% or something like that. So my views may be a little different there.
The way in, they messed up.
Yeah, they were so late on the way in, and if you step
that's
way
not a good
back,
reason to go too far now.
Wait. If you step way back, look, the Fed's had a tough year. They really have. Probably the worst year in the history of the Federal Reserve System because they misjudged inflation. And a few months later, they gave markets reason to think they might pause or pivot, and they've been playing catch up for so long.
True. For
them to have stopped yesterday and then turned out to be wrong, and they could have been wrong in terms of inflation not trending down in the direction everybody wants. I mean, that would have been catastrophic.
Yeah, how about having to cut a month from now because of making things worse? That's happened. You've seen that happen in the past.
I know. I agree with your previous guest, though. I think anticipating short-term cuts, I don't think that's likely.
How much do you think the credit tightening that we are seeing that?
Okay, let's play that out. Okay, so could they cut in a month? I would say it's not a huge probability, but it is a possibility. All they would need to do is get some financial institution to go under. That's too big to fail, and we haven't seen that yet. The financial institutions that have gone down so far have been okay. They haven't freaked out over that. And a lot of these different regional bank players. If we see like a top 10 type financial institution go under, it's a whole different scenario there. Where something that there's systemic risk and it pulls down this one and this one and this one, that's a different scenario. So I don't know, when you see how rapid the banking system has deteriorated. I mean, look at the KRE. We just talked about it, right? Look at these regional bank stocks. Look at how fast things have deteriorated there. To assume that couldn't happen to even a further extent, I think it might be a misjudgment. I mean, certainly it's a possibility, right? And so that would be, if the Fed had to cut rates in a month or even 2 months, it would look so bad. It would look so bad in the Federal Reserve. To be quite honest, it would just be the last stage of embarrassment on that whole side then at that point in time.
We're about to see from the regional bank crisis. How much do you think that translates into in terms of tightening?
Well, I think the combination of QT and some of lesser lending capacity or willingness is relevant. And I'm not smart enough to know whether that's 100 basis points equivalent on the funds rate or what precisely number that is, but I think that is relevant, yes.
I mean, that's an order of magnitude. 100 basis points is a tremendous amount. So why would you take off the table a Fed cut later on this year? Because the Fed came out and said
So really two people are missing today, because Becky Quick's usually the woman that does this show. Melissa Lee's like the fast money lady.
If we were 100 basis points higher right now, you might say that.
Well, Melissa, I don't know that the Fed won't cut at all by year end, but the spread in the federal funds futures markets, as you were talking about earlier, between the Fed's official forecast of the funds rate at the end of the year, which is in round numbers 5.25%, and the futures markets forecast, which is up to 100 basis points lower than that, depending on the day, that implies a series of cuts. That I doubt.
Roger, a lot of people on strange bedfellows always in politics. I was watching Senator Elizabeth Warren was on our air yesterday, and I found myself nodding like a lot. And
by the way, personality-wise, Melissa Lee, she goes a lot better with this Joe guy. He's a little bit of a character, and Melissa Lee's used to dealing with a bunch of characters on that Fast Money show. So she's actually a much better fit for this show, I will say, than Becky Quick. Becky Quick's very serious, and she tries to, I think she's more annoyed with Joe. I think that's my perspective on it, of somebody that's, watched these people for 10 plus years now. I think she gets more annoyed with Joe's personality sometimes. I think she's accepted of it over time, but she's more of a serious person that just really wants to talk about serious subjects. And I think Melissa Lee's more of a fun going, can keep it serious, but kind of joke around. So I feel like those two would be a better match than Becky and him, to say the least. The other guy's actually a good fit for Becky Quick, though, the other one that's missing today.
So then I just pulled myself away for a second and slapped myself a couple times. But I really...
just when I said that, what perfect timing.
I was agreeing with everything she was saying about the Fed. This is no way, to putting people out of work is no way to try to improve an economy. Trying to slow the economy, that's the only tool they have. But in a perfect world, you'd wish you had something better than what the Fed is trying to do. And when you raise rates on the supply side of things, that's inflationary for anybody trying to start a business or borrow money. It dampens you have fewer people with jobs because they aren't expanding because rates are too high. It just seems like it's counterintuitive how it works.
The degree to which the Fed originally misjudged the tenacity of this inflation, as we all know, has really been harmful.
What was it? What caused the inflation, Roger?
I think it was a pandemic myself.
You do? You don't think it's the spending or the
I wouldn't say that has no effect, but I think the primary cause is the pandemic. And if you step way back, the economy stopped. Everyone was at home. Mm-hmm. Large recycling of stimulus payments or transmission of stimulus payments. Economy starts up much faster than people think. People are at home. They can't spend on the normal things they spend on, going out to eat, travel, hospitality. They have a lot of liquidity because most people retain their jobs and they received these payments, and they couldn't spend on a lot of traditional things. So what did they do? They spent it on goods, especially goods that pertain to the home. Might have been a bicycle, might have been a grill, might have been whatever you can do DIY at home.
Yep.
Demand for certain types of goods was huge, outstripped the capacity on the supply side. You saw inflation on the goods side. It leaked over to the services side, particularly in terms of labor. And to me, that's the main cause of this inflation.
Yeah, 100%. He's 100% on. Now, the issue is, major issue. So if the Fed, a lot of people think if the Fed keeps rates too high for too long and, I don't know, the economy gets hurt, they can just come save the day. It doesn't really work like that, okay? They can save it over a period of time, but it's not like they can save it overnight. And the reason being, and the other issue you have with that is, let's say all of a sudden people start losing jobs a ton. Let's say the economy becomes a mess. Let's just say hypothetically that happens, right? Because the Fed kept rates too high for too long. And all of a sudden, let's just say hypothetically 2024 is a mess, okay? If that's a scenario, what do you think is going to happen? money printer. Next thing you know, what's going to happen with the Fed's balance sheet? It's going to skyrocket again. Government debt's going to skyrocket more than anything we've seen in the past, because next thing you know, they're going to have all these $1 trillion spending bills that are going to have to go through as like these emergency things. And so, you know, that's the danger of that. And then you're going to end up with debts that are far bigger than they are now. And you're going to end up with a whole other mess you got to clean up. And so, you know, these are just some things to factor in. And inflation's a problem, no doubt. But I can tell you, just as big of a problem, if not a bigger problem, is when you got very high unemployment. That takes years to climb out of that, and it could take $5 or $10 trillion to climb out of that mess. Look at what it costs in the great financial recession to get out of that mess. Look what that cost the government. That was back then. That was 15 years ago. Can you imagine what it's going to cost today to get us out of that sort of mess? Whew. So that's the danger, and that's something that has to be factored in there. So appreciate everybody joining me as always. Thanks so much to everybody that's subscribed to the channel. If you're looking to join my Patreon, that will be the pinned comment down there. I'm making moves in there tomorrow. You get to see my portfolio. You get to see all the moves I'm making in there. And yeah, other than that, much love and have a great day.